Hi, you're listening to Stefan Livera podcast, a show about Bitcoin and Austrian economics. Today, for episode 212, my guest is Alex Daskalov, and we're talking about whether Bitcoin in custody can be insured. This show is brought to you by swanbitcoin.com, the best place to auto-stack your Bitcoin in the US with incredibly easy setup and low fees. I personally appreciate that Swan is Bitcoin only and dedicated to Bitcoin education. Go to swanbitcoin.com/Livera to get $10 of free Bitcoin when you start stacking with Swan. And Swan has some news to share. They've had massive demand for daily buys since the day they launched the service. One of the big positives of regular and recurring buys is smoothing out price volatility, so buying daily will catch those dips even better than buying weekly. There are a limited number of spots in the Swan Daily Buys beta, so head over to swanbitcoin.com/dailybuys to get into the beta. That's swanbitcoin.com/dailybuys. Knox is a Bitcoin custodian dedicated to ensuring their insurance protection covers the full value of their customers' assets, which we'll discuss in this episode. So, for example, if a fiduciary wants to hold $250 million of Bitcoin with Knox, Knox will seek to obtain $250 million of insurance dedicated exclusively to that account and adjustable to volatility. No fractional coverage or narrow scope. Insurance for what it's worth, a tool to transfer risk. If you're a Bitcoin company, investment fund, trust, or family office, check out Knox for your insured custody. KnoxCustody.com. Lastly, Unchained Capital, Bitcoin native financial services. Unchained are doing great work to make multi-signature accessible. If you're thinking about your Bitcoin security, why not consider going from zero to multi-sig with Unchained? Now you can either build it yourself with no setup or storage fees, or if you want assistance, there's the Vault Concierge onboarding package where you can have hardware wallet devices mailed to you and have guided setup calls to build your vault together. Prices range from $1,500, which includes 2 hardware wallets, to $1,200 without the hardware wallets, and that includes $1,000 to go in the vault also. Use code Livera for a discount. If you're interested, go to unchained-capital.com to find out more. Now, just for clarity, Knox is a sponsor of the show. However, I invited Alex on because I thought it was worth a discussion for the listeners to have that discussion on the show in its own right around Bitcoin custody and insurance. So here's the interview. Alex, welcome to the show.
Hi, Stefan. Yeah, it's great to be here.
So, Alex, I've been following what you're doing with Knox, and obviously just recently Knox has started as a sponsor of the show, so listeners be well aware. But I thought there was some interesting stuff here in terms of what Knox Custody are doing and some of the messages that you guys are putting out there in terms of insurance and Bitcoin and how can these two things be combined? Can they be? But let's start with a little bit about yourself. What's your background?
Yeah, sure. I think I'll give you kind of a brief rundown of how I came into this space, kind of how I came to be involved with Bitcoin broadly, and then certainly insurance, given the focus that we have with insurance at Knox. So to really backstep a little bit here, I moved to Montreal in 2006, which is obviously a long time before even Bitcoin came to be. But this ends up being pretty important as far as I can tell when I look back at history, because Montreal really shaped me as a person and especially in the Bitcoin space. I came upon Bitcoin for the first time in the summer of 2010. And at the time, I was practicing what I'll call kind of the three mentions rule, which is I came to see too many new technologies, too many kind of different things, and was always distracted. And told myself, if I see something mentioned at least 3 times, I have to check it out. And certainly, if I see it mentioned more than that, then it's something that worth getting into. So I'll call summer 2010 kind of my 0 to 1 moment. You know, there was a time at which I had no conception of Bitcoin, had not ever heard of it, did not understand anything about what it was about. It didn't even register in my mind. And I came to see this, and I should maybe paint myself kind of the kind of person I was at the time. I was absolutely a software kind of first person. I was a programmer. I was bouncing around at different projects, seeing what kind of software is being built and what kind of things it could do. So I can't claim to have understood Bitcoin at that moment very well. In fact, I'm certain that I did not understand it very well, because had I understood it then as I do now, I would have obviously dropped everything to focus on Bitcoin and nothing else. For me at that moment, it was really just, let me download this, let me download the source code for this thing, build it from source, get a binary going, operate that thing, see what it does, kind of poke around at the source code, understand briefly what it is. But I cannot claim that I was getting especially deep at the time. But that was my first foray. That summer, I was developing some software that, give it the TLDR, was really just a way for people to build, um, kind of release some albums and have anyone pay whatever they wanted for those albums. And at the time, I started integrating with kind of Amazon payments, seeing what it was like to actually get somebody to pay for something over the internet. To be frank, at that time, I had obviously used payment rails, but I did not understand, what it meant to actually, send money over the internet. And I came to appreciate just how horrendously complicated the traditional kind of financial services rails were. And it's at about that time that I came to remember, hey, what about that Bitcoin thing? Maybe that it was something that is worth integrating into the site. And for better or worse, I looked at it and said, well, nobody really has Bitcoin, right? They don't. This isn't something I unfortunately can actually integrate because this isn't actually something that people have. But it's at that moment, I think, that I came to realize there's something magical here because where in the traditional kind of financial services payment rails, I have to integrate all of this old legacy tech and I need to get the permission from all of these different providers to actually have anything working. With Bitcoin, actually just get it working without anyone's permission. And that was something that I definitely noticed as much as I kind of passed on it because told myself, folks aren't actually using it. So um, that was a fairly long-winded point about 2010, but a lot of things happened for me then that set the staging ground for everything that I would come to learn later. To kind of run through the years that have passed since 2011 was my final year of school. About then, I came to meet some libertarians, kind of get involved with some campus groups. It was my first real exposure then to kind of Austrian economics. A lot of these folks did not know Bitcoin or point me to Bitcoin, but they kind of proved to me or sort of told me, I think for the first time, I came to realize, the US dollar is not forever. And I came to recognize fiat currencies for what they were. And I think it's hard to kind of back up historically and understand where you were. I don't think that these two things click together. I'm pretty sure at that time, I was that programmer who had come across Bitcoin and had understood it as a permissionless, payment rails. But I don't think I made the connection between kind of the Austrian economics that I learned about in 2011 and Bitcoin as a technology. Kind of fast forwarding. So yeah, that was I think, and that's actually a point. Is it's really difficult to kind of back up and remember at what point these things clicked. And I think this is the case for everyone. It's a lot of these things kind of they build up over time. But for myself as a technologist, as a programmer, like when I came to understand Bitcoin as money is frankly an open question.
Depending on what your vision for Bitcoin is and whether it makes sense for people right now who are mostly holding it, and that story, I suppose that also plays into why you wanted to do a custody business, right?
Yeah, certainly, and it was a long time coming for me to get into custody. So, if I can kind of progress through this point, it really wasn't at that time. I was a fairly staunch, not your keys, not your coin. Still something I believe in. I certainly believe that individual users of Bitcoin ought to maintain their own key storage. And it was a long time coming before I came to realize why custody would ever be necessary, and what kinds of things would be necessary for it. So, kind of, yeah, and certainly not in 2011 or 2012 would I have come to understand that. I was still at the time deeply just a technologist. So I would say in 2012, then um, I started seeing some of the first uses for Bitcoin. Besides kind of the first uses that I saw where I had to discount it. Historically, I've been what you'll call a harm reductionist. So I believed, for example, that psychoactives may, in the right hands, used correctly, be a useful tool for folks. And about that time, I started seeing some of the first darknet markets and saying, maybe there's something here where people can actually use this thing to get somewhere. And then the technology side of me at this time was really interested in distributed computing writ large. So I really, I came to be fascinated by things like the cap theorem, the idea that you can't get consistency, availability, and partition tolerance in a distributed system at the same time. and really started seeing that while there were all these kind of distributed databases that people had built in a centralized sense, Bitcoin was solving really a very interesting problem that none of them had actually you know proven out in any way. And then kind of moving through that, about 2013, I would say that was the first time that I started seeing, people getting really serious about this thing, saying things like, "I'm going to invest all of my life savings, into Bitcoin." I remember having these thoughts. It was about the fall of 2013, kind of reading these posts and thinking, these people, they're probably right, but they're also a little bit crazy. Like this isn't something that that I believe at this point. Even though I remember the first tinglings of, you know, I think that if I look back in years' time, I'm going to look back at this time and say, actually, they're right. And so that's yeah, that's about when I started getting more serious about this whole thing. It was just, and I think this is the case for a lot of folks in the space. Is you see this thing at first. Certainly, when I first saw it, I looked at it and said, "This is a really neat thing. If it should ever work, it would be incredible." And again, certainly, I thought of it from a technology standpoint. But after seeing it evolve and not die for years and years and years on end, that's when I suppose I got more and more serious about it. So fast forward many of these years, and I can certainly jump into kind of what I was thinking about in the years of kind of 2016, 17, 18, when I came to build Knox.
Yeah, sure. So let's talk a little bit about what made you want to start up Knox Custody.
Sure. So, I guess backing up to the kind of not your keys, not your coin point, this is something, I still believe, and I think it's important for everyone to hold their own keys. But I came to realize that I was being a little bit naive in the sense that there are many contexts in which, somebody simply cannot hold their own keys just because of the mechanics of some mechanism. So, you might have a situation, for example, in which suppose somebody were doing something like a Bitcoin fund where they were deciding when to execute purchases and sells. Somebody came to you and said, I know a way to actually grow your stash faster than just buying and holding. Um, of course, that entity would have to maintain control of the coins, maintain control of the keys. I came to believe in the situations in which you are not, you ultimately own, or you are supposed to get at the proceeds of some activity. If somebody else is going to hold your keys, I came to recognize, well, if somebody else is holding your keys, they ought to be fully insured. And it's about that time that I started realizing, none of these safekeeping services are insured to the level that I would want to see insurance coverage if I were actually utilizing them.
That's probably the main differentiator that I see in terms of Knox Custody. But I suppose, how do you sort of address that idea that someone listening might be thinking, well, hold on, isn't custody against Bitcoin's ethos?
Yeah, certainly, and that's definitely something that I came begrudgingly to kind of have to accept, which is it is against Bitcoin's ethos if we're talking about um, somebody maintaining direct ownership of Bitcoin as an asset. So I still believe, and I'm still very very staunchly supportive of, and the very very strongly push, folks to hold their own keys. If you would like to do the simple activity for Bitcoin of owning some Bitcoin, I still believe that people ought to own their own keys. However, if you would like to operate, for example, a fund wherein you are holding Bitcoin on behalf of others, then in that case, you not only should not, yeah, you not only you can hold your own keys, but you in that instance should not hold your own keys because those are the keys that are being used for the assets of some other party. If that makes sense, kind of like a in the case that you are maintaining control of somebody else's Bitcoin, for the most part, unless you're a specialized custodian, I came to believe that you should not be holding those keys.
I see. So, from your perspective, then it's more about the level of security that, say, a fund would be able to provide on their own versus a specialized custodian. Is that what you're getting at there, or something else?
Yeah, I think there's naturally kind of a specialization of labor point here, which is if you're, for example, a fund. it's very unlikely that you've spent the cycles that you need to get the kind of security that somebody who is a specialized custodian can attain. And then certainly from our standpoint, the ability to actually insure these holdings is something that, and I'm sure as we'll get into this conversation, is incredibly difficult to do. So I came to believe exactly that, which is in most cases, if the mechanisms allow it, folks need to hold their own keys and hold their own coin. But if they're going to delegate ownership onto some other entity, that entity, unless they're a specialized custodian, ought not to be holding those keys.
Yeah, so I think I take the point about technical competence, specialization, requirements for a higher level of security, and in certain cases, the entity, the structure may not be able to self custody. But that said, could there be some kind of risk scenario where, let's say, Knox is successful and holds 1% of Bitcoin? Would that be bad for the network? Would that be bad for the overall health of the ecosystem? What's your view there?
Yeah, it's definitely something that myself and everyone at Knox has been troubled by, which is what happens when these custodians are successful, and what happens if actually a large percentage of Bitcoin in the aggregate is held not by users who are holding their own keys, but by designated entities. I do think that if it came to be a very large percentage of the network, that would be a problem. Um, the way Knox is structured to this day, for example, we say 1%. 1% of the total supply of Bitcoin is a supply of Bitcoin in real dollar terms today that Knox is not actually capable of holding. The way, and I'm sure we'll get into this when we talk about kind of capacity limits. One of the ways that you will be able to scale actually the insurance capacity that we maintain is by having many different entities actually maintain the same infrastructure that we actually ourselves deploy. So that's certainly one point. I do push back a little bit on kind of the harm to the network in this regard, because while it might be the case that many different entities are holding on to some percentage of the aggregate Bitcoin, it is still the case that all of the individual holders, if you will, are not harmed. So if you can picture this, you and yourself, myself, we might be holding some amount of Bitcoin. We might be holding our own keys. The fact that some other subset of the aggregate, supply is held by centralized venues, does not take away from our ability to access access the base layer. So that's still a very neat property of Bitcoin, that it does not. While I do not want to see a world in which a large percentage of Bitcoin is held by centralized entities, if that were to happen, you and I and anyone else holding our own keys can still transact our Bitcoin just as we could previously.
Yeah, I see. And it is a consideration that, let's be fair, there are already existing custodians today. For example, Coinbase Custody or BitGo or Anchorage or some of these other providers who already do hold a significant proportion of Bitcoins on behalf of their customers. They're obviously, the messaging is sort of getting out there. It seems that more of the coins are going out into individual custody, but again, there are different entities out there, and some of those entities are just not capable of custodying everything fully and doing everything fully themselves. So probably it's useful now to talk about who are those entities that are not able to hold their own keys, and maybe if you just want to comment a little bit on your view of that spectrum there of fully owning keys, doing everything yourself, over to the other end of like fully custodial, and who are the kinds of people who it makes sense for.
Yeah, so I think maybe there's two kind of points here. One is looking at the kinds of categories of customers that, for example, Knox services, and the other is, and this is actually an interesting point, and kind of we can tie this in with the last point, which is what is the spectrum of custody, if you will. So on the first point, I'll kind of cover some brief categories for Knox. On the one hand, is very straightforwardly Bitcoin businesses. So as a side effect of these businesses' operations, they come to hold a large amount of Bitcoin, and we can look at kind of two typical examples of these folks. One is Bitcoin exchanges. A Bitcoin exchange, say it buys and sells Bitcoin versus fiat. For better or worse, it turns out that a lot of the users of these exchanges themselves do not wish to hold their own keys, and I think that that's maybe a point I should have made on the last point. And as a result, and we all know that this is the case, centralized exchanges end up holding a large amount of Bitcoin. This for them is a cost center. It's not something that they want to do. We know these people; it keeps them up at night. It's not, again, a specialized activity that they want to take care of. But because their own users don't actually want to withdraw onto their own wallets, they end up holding these things. So that's certainly one example. Another example might be a lender, somebody who wishes to take Bitcoin as collateral in order to produce a loan, has to, by the mechanisms of Bitcoin lending, hold on to some amount of this collateral directly themselves. And again, this is often something that they don't want to do. So these are perhaps two examples of where it is not possible or it is not desirable so far as the end user is concerned for Bitcoin to be held by them, but kind of by the end user. As a second category, and something that we've seen a lot of growth in, we're seeing a lot of the new entrants into Bitcoin. So, say high net worth individuals, family offices, others of that sort. They want exposure to the price appreciation of Bitcoin. They want to know that they have access to the physical Bitcoin in the sense that they want to be sure that they are actually owning underlying Bitcoin, as opposed to just some synthetic. And again, as a side effect of this, they need some custodian to hold on to their funds. And then, as the last category, there are public funds, or kind of listed funds. If you want to produce some fund that sits in such a way where folks can kind of produce shares for this, kind of redeem those shares and purchase those shares, then it would result in physical Bitcoin having to be stored by a third party. So these are a few categories where Bitcoin does have to be stored by something resembling a custodian. The second point for this is, and this is something that we're investigating internally a lot, is what is kind of the spectrum of custody. So we can look at the case that should be for most users, which is they hold their own keys, they hold their own coin, they have the full signing quorum, all the way to the extreme end where there exists a custodian that maintains the full key set, holds the ability to gain signing authority over some account and the ability to move those coins. In between that, there are some other models, such as, for example, collaborative custody, and something that we're spending a lot of time internally looking at, which is, um, you know, given the advantages of multisig, maybe it does not have to be the case that 100% of the keys are held by the user or 100% of the keys are held by a third party custodian. In an M event scheme, you can kind of get arbitrary levels in between. And that's certainly something that is of interest to us. And I think one of the ways to battle against, um, large percentages of the aggregate supply being held by centralized custodians, is to start imagining ways in which collaborative custody really, really takes hold in the world.
As I can imagine, there might be obviously there's some strong benefits there to the collaborative custody model, but I guess on the downside there is essentially that company or that trust or that family office or whoever, they have to take certain trade-offs, and one of those might be needing to be more active in terms of how they use their own Bitcoin. There might be certain constraints about their own time and so on. Whereas if you're sort of passing that off to a company to do certain automated policy rules, that's a bit of a trade off there as well in terms of being able to use that, as opposed to, like, it might be a bit more technologically or human capacity wise, it might take a little bit more, right?
Yeah, for sure. And this is something, we all have to admit to ourselves these are early days. And it'll be interesting to see the different models that take hold. And certainly amongst, say, family offices, looking at what the specific risk appetite is, looking at what, there's always trade offs between security, sovereignty, and a number of other properties that you can look at in a custodial system. But it certainly is important to note, and it's interesting for Bitcoin in particular, that we get this interesting continuum, this kind of spectrum of custody. It's certainly not something that we can get to see in gold, right? Say when it comes to gold, somebody's either holding onto that gold or somebody else's. We don't get to see this kind of interesting spectrum of different models by which we can custody coins.
Sure. And so let's talk a little bit about insurance as well. So this is something it has been often requested within the space, and yet there are difficulties around actually achieving insurance for custody. So let's just start by talking a little bit about the factors that might make Bitcoin hard to insure. So what makes Bitcoin so hard to insure today?
Yeah, so that's a great question. I think I can back up a little bit. I got interested in insurance systems as a software person about 6 or 7 years ago. And that's when I first started kind of getting into insurance. I came to recognize some facets of the insurance industry that would make it difficult to insure Bitcoin. But we can even generalize from there to understand why insurance of software broadly is difficult. So, insurance, if I can really simplify matters, is just the act of looking at a set of events. So long as there exist some events, and there are some events that are bad, and some events that are neutral, and some events that are okay. Um, so long as I can understand the bad events and understand the extent to which they correlate, based on some input parameters, I can likely produce a model that I can use to actually price that risk. So, as a very crude example, suppose I wanted to insure against the physical destruction of ships. And I had some ships that were sitting in the Atlantic Ocean, the Pacific Ocean, the Indian Ocean, and elsewhere. Um, one of the properties of the world that makes ensuring traditional risks relatively straightforward is that most of the bad events that we care about have to do with physical destruction. And they typically have to do with physical destruction as it occurs in the real world. And the real world affords us a wonderful property, which is that when items are physically distant, they are unlikely to correlate in their destruction. So, for example, a storm in the Indian Ocean that might take down some of your ships is not going to take down your ships in the Atlantic Ocean or the Pacific Ocean. What happens in software systems is that a lot of this convenience breaks down. Suddenly, all of the events that could occur may correlate in ways that you did not previously understand. So this is kind of a point about why it's so difficult to insure software systems at large. And Bitcoin really starts to have a lot of these kinds of properties, which is the kinds of events that can occur in Bitcoin start looking very much like information risks. So you will not see necessarily physical evidence for some of the risks that we care about. So, for example, if agents who are generating keys that will be used in a multi-sig quorum come to behind the scenes, copy some of these keys and then use these keys in a long range attack in order to steal Bitcoin. That is not going to result in kind of physical evidence for that loss. And so that is one of the major points that makes insuring against Bitcoin theft and loss so difficult is that it represents the kinds of risks, it kind of represents the kind of properties that makes software risks so difficult to insure, which is that there's not always going to be physical evidence for their occurrence. So that is, broadly speaking, what makes insuring software difficult, and certainly what makes insuring Bitcoin theft and loss difficult. I can run through. I think maybe a useful exercise here is to say, what were we thinking about at Knox when we first came upon this as a risk category? Kind of what events did we want to insure, and why were each of those so difficult to insure? So the properties that we looked at really were to say, and I'll use these to comment certainly on insurance policies as they currently exist or certainly existed at the time. One of the things we really believed important is to ensure up to 100% of the value of the funds that we held ought to be insured and ought to be insured in a dedicated fashion, which was certainly not something that was happening at the time. So, kind of the run of the mill for insurance policies here is you will purchase some insurance policy. So, say you're holding, call it $500 million worth of Bitcoin, you might purchase an insurance policy for $50 million worth of Bitcoin, and then you might turn to each of your customers and say, your account is insured up to $50 million. Now, the problem there is if you're holding the full sum, that statement, while technically true, it's a little bit dubious, right? You don't actually have the ability to insure everyone's account up to $50 million if your aggregate holdings significantly exceed that. So this is fractional insurance so far as we're concerned. Effectively, you're double spending your insurance policy. And that's something that to this day, yeah, it's a great way for Bitcoiners certainly to understand it, is to just effectively look at it as double spending an insurance policy. So far as we're concerned, that's not appropriate. And so we really strongly believe that when we say one-to-one insurance coverage, we mean that for every dollar of Bitcoin that we hold, we are purchasing a dollar of insurance coverage, and that is going to that customer and that customer alone and nobody else.
And how about the volatility as well? So it could be the case that, and this can happen in both directions, right? So imagine, it's 2017 and you've bought some insurance and the price of Bitcoin is whatever, $4,000, and then it runs to $20,000. Now, in terms of US dollar in US dollar terms, you might not have enough coverage now. And then kind of the flip side as well, if there's a big drop, what do you do then? So I guess the volatility aspects of it are also a challenge in terms of getting the right level of coverage. How do you deal with that?
Yeah, so volatility is, yeah, and it's a great point as we run through kind of the properties of insurance that we think is important. So when I say one to one, obviously it needs to also be able to scale up and down with the volatility of Bitcoin. Now, it is the case that there were assets, before Bitcoin, for example, any kind of commodities insurance that you might want to provide, where there was a daily difference in the US dollar denominated risk that was being originated. So it's not as if Bitcoin is completely novel in this regard, but the kinds of violent price swings that we see with Bitcoin, did not occur for other insurance products. It is something that we have managed to deal with. Now we deal with it in terms of kind of bands of insurance, if we will. Um, what we do is, one, we backtest these things and say we want to tell our customers, given historic price volatility, is it the case that if you bought or if you kind of came into our custody, our fully insured custody, that we would not have been able to deal with some historic volatility? I'm proud to say that to this point, there is no historic volatility such that we would not have, managed to actually take that price swing. But we're also extremely transparent and we like to be as open as possible with what our insurance coverage is. And I will note that, yes, there absolutely exist price swings so violent that they can push the insurance coverage into a window where some holdings might no longer be insured. But you would be surprised at kind of how wide of a price swing we can actually take.
I see. And when you're talking about historically, are you talking about as in a back testing sense, like you went and looked back at the volatility of Bitcoin like that?
Yeah, yeah. In the sense of saying, we can't make future promises, in the sense that if Bitcoin popped by 15x in in 3 days, perhaps we can't take that. But the question is there any situation in which our customers would have seen less than one-to-one coverage? I'm proud to say that historically that is not the case, but I also like to be honest to say that it is absolutely possible for price swings to be extreme enough to pull people out of the bands that we target.
Well, maybe if we see that crazy volatility in the years to come, some crazy hyper Bitcoinization event. But until then, I think that's the other point as well around lack of historical data. And Bitcoin is still relatively young, right? It only started in January 2009, and here we are in September 2020. So was that also a difficulty, and how did you sort of get across that line in terms of having insurers essentially come around on that factor?
Yeah, and I think this gets back to kind of, I often like to think about Bitcoin insurance in the context of what it means to insure software broadly. One of the other interesting things that happens with software systems is that the time from which a kind of risk originates to when people are really dying to get this thing insured, that time is reducing. It is reducing for every single risk category. So think of it this way: when the Wright brothers first flew a plane, there was no need for insurance for aircraft of any kind. By the time that insurance for aircraft was kind of made necessary, the insurance industry had a lot of time to stretch itself to understand that risk in order to provide that kind of coverage. From the time that Bitcoin first appeared, as you can imagine, in 2009, nobody was looking for Bitcoin insurance. Now, 2020, tons of people really badly need this risk insured. That time span is in the history of insurance very small. And so this is something that we're seeing for risk categories across the board, which is the insurance industry, besides the fact that it has a very difficult time insuring against non-physical kind of events, has a very difficult time insuring against events that it did not even know existed less than a decade ago.
Yeah, very difficult times and very rapidly changing times. One other point I was interested to chat about is which threats specifically are being insured. So, a couple examples here we could think of, key loss, maybe theft, or we could talk about internal collusion. How do you think about that, and how do you sort of name and specifically address those?
Yeah, sure. So I think we can continue then on kind of the point I started with, which is looking at the different properties that we at Knox thought were important to insure. So we really looked at this from the very beginning and said, if we were to entrust a third party custodian with our Bitcoin, and that third party custodian were to claim to be, quote unquote insured, what properties would we seek? What properties would we demand of it before we deemed it properly insured? So one I've already covered, which is 100% of the funds ought to be covered, as in 100% of the value ought to be covered one to one. You made a great point about if you're going to claim one to one coverage, it also ought to scale up and down with volatility. The final properties, though, that we looked at were that it ought to be insured against the destruction of key material, which is to say, this is the classic, I lost my mnemonic, or, it's been destroyed, or just even though the Bitcoin is still there, the UTXOs are correctly encumbered. I can no longer move them due to the fact that I have lost signing authority over my account. That's certainly something that, of course, we thought needs to be insured. It needs to be insured against external theft, which is to say, some agent reaching into our system, whether by way of directly reaching into the archival layers or anywhere else, gaining signing authority over an account and then stealing Bitcoin, that needs to be covered. Both of these first kind of the events, this event and the one I just spoke of, are, I don't want to trivialize it. They're relatively straightforward to cover. Many people had covered them before. It's still a difficult thing to attain, but it's not a kind of monumental challenge compared to the next two. And the next two are that we really believed that theft and loss needs to be insured even against internal collusion. So if you look at the history of financial services and certainly even the history of kind of Bitcoin thefts and losses, people stealing from the inside is one, the most common, and two, the most difficult to deal with threat. So we looked at it and said, if I'm going to entrust my Bitcoin with some third party, and that third party is composed of what? Just a bunch of humans and some processes and some machinery, then I had better have an insurance policy against them stealing from me, even if they steal and disappear completely. So that was a critical point for us. And it's something that we really hold ourselves to, which is it must be insured against internal theft and collusion. And if that property is not attained, then the insurance is not, you shouldn't even call it insurance, frankly, just because that is the key activity that you want to be safeguarded against.
Yeah, so I think that's certainly an interesting factor and an important factor, as you mentioned. Also, one of the facts of our current world is that a lot of insurers rely on a reinsurer, which is like an insurer for insurers. And it might be also fair to say that a lot of, at least in the US, a lot of US based reinsurers, to some level, they might be able to place some level of reliance or some level of comfort gained from having the FDIC to be able to print money, or the US government could technically, be that lender of last resort, some way to kind of bail out that system. Whereas obviously in a Bitcoin world, that doesn't exist. So I guess someone, a skeptic might think, well, hang on, how are you dealing with that problem?
Yeah, that's certainly an interesting point. I think in the present moment, where Bitcoin is at the moment, not yet a proper full world reserve currency, um, and insurance for Bitcoin is denominated in US dollars, and a lot of the insurers are, and this is certainly something I think we should get into, which is kind of um, what are the regulations around insurers, and how do they actually come to insure against Bitcoin. But to your point, there exist shock losses, which are losses in insurance systems so large that they could render the insurance system, or at least some set of carriers, completely insolvent. In the traditional world, kind of forget Bitcoin for a second, but in the traditional world, it would be obviously a horrendous event if a large number of insurers were made completely insolvent, such that they could not cover the claims that they needed to cover. And in those cases, there does exist a lender of last resort in the U.S. insurance system. Of course, that is. The US government is capable of actually backstopping the entire market and saying, we will prevent these insurance companies from falling by way of actually administering these claims. And this is something that there have been a few events in history where we nearly saw that situation transpire. Certainly, actually, 2020 is an interesting point, and there's a lot of debate at the moment as to, whether insurers ought to be on the hook for, business interruption, for example, or sort of a lot of the other events that have occurred as a result of the reactions to kind of the current situation. Um, it is as complicated a problem for the future Bitcoin denominated world as it is for the present, which is, for better or worse, there do exist shock losses so extreme that the entire industry can rupture. It is anybody's guess as to what that looks like in the current system. But it's certainly something worth exploring as we get into an increasingly Bitcoin denominated world.
Essentially, it just kind of really drives home that whole point. As my friend Michael Flaxman says, there are no bailouts in Bitcoin. So, but I think for people who are, I suppose, you think you want to insure against a certain risk, and you're, I guess, you are not as concerned about that kind of extreme level of risk. Well, then this is something to think about.
On the last one, I would have to actually model that out, but this is one example, for example, why you do not want 100% of Bitcoin to be held by centralized entities, even if they are insured, because it is not, so far as I can kind of contemplate mathematically, possible for you to do that in a Bitcoin denominated world and have the entire system be fully sound. So you have to have some large amount of heterogeneity in terms of the method by which Bitcoin is held. But this is a topic that I'm sure we'll kind of get through as we start seeing increasing sums held by centralized custodians. But it is important that they not be held by the same entity, or at least not by the same systems.
I see. And just in terms of limits, are you able to share anything there in terms of what kind of limits, like if somebody's got a lot of coin, or if they're a large entity, is it possible that they wouldn't be able to work with you because, let's say, the amount they hold is above the limit that you could insure for?
Certainly not something that we've come to see. We always appreciate a challenge. Again, if we want to talk about kind of scaling insurance capacity into the kind of scale that it needs to get to, if we anticipate Bitcoin getting into the kind of realms that we expect in the next 5 to 10 years, there's a lot of work that we at Knox need to do, and certainly the industry at large. It is not possible for the current Knox setup to, insure, for example, 5, 10, 50 plus $1 billion worth of Bitcoin as it stands. I do think, and yeah, I do think it is possible in a theoretical sense, and in a practical sense as well, for that to be done. But there's a huge amount of work to be done for that. We have constantly been challenged by customers coming to us, wanting to insure larger and larger sums. So far, we have not broken, but it is definitely a very interesting kind of technical challenge as to how we can actually scale insurance capacity for Bitcoin.
I guess without getting like too toxic about attacking competitors or whatever, but if you could just give us a bit of a outline in terms of how you're viewing your product and your service as compared to some of the competitors such as Coinbase Custody, Zappo, BitGo, etc.
Yeah, certainly. I mean, certainly a big one is that we're focused on Bitcoin. We're focused on the Bitcoin base layer, and we're focused on increasingly in our roadmap, kind of looking at the layers that exist above it. We believe internally that a focus on Bitcoin is going to be a huge boon for us. I think a lot of folks, we all know that key to building great systems from an engineering standpoint is focus. And the fact that we do not have to deal with, for example, thousands of different digital assets, as is the case for most custodians, is going to be a huge, um, something really in our favor. Besides that, certainly the insurance focus, it's something, insurance is never done any more than a software system or hardware system is complete. Um, as great as we believe our insurance is at the moment, it is something that we are constantly developing. It is something that we strongly believe in. That institutions and other folks who are not holding their own keys or are holding Bitcoin on behalf of others will need this kind of insurance. We really mostly differentiate ourselves on those two facets, which is really a hardcore focus on Bitcoin specifically, and on the ability to insure against thefts and losses that can occur in our systems.
Excellent. And let's talk a little bit about the security setup as well. Now, obviously, I understand there'll be some components that you can't disclose, as you shouldn't. But can you just give us a bit of an overview around what you're using in terms of things like multi-signature, multi-jurisdiction, any of those aspects you'd like to highlight?
Yeah, I think so. This is going to be difficult to do by voice, but let me give it the best shot. And certainly, I encourage anyone who would like to learn more to reach out to us, and we can always, deep dive with some graphical presentations. What Knox implements today is a 3 of 4 multi-signature setup. We generate keys in 4 distinct cities around the world. We do so in absolute sequence, which is to say, kind of no key is generated at the same time as any other key is generated. Each key set is completely independent from any other. So when we say 3 of 4 multi-sig, we don't mean it's a 3 of 4 multi-sig omnibus where we take some paths down a BIP32 tree in order to afford some set of customers' unique addresses. It is the case that at the entropy layer, the accounts are completely segregated and distinct. The accounts for each of the 4 cities are vaulted ultimately in 4 distinct vaults per city. So this results in kind of 16 distinct vaults per customer account spread across 4 cities, 2 continents, 3 countries. And then one of the unique things that we do is, and this was really critical for us to be able to attain the kind of collusion resistance that we needed in order to be insured against the collusion events that we are insured against, which is we have some proprietary HSMs that in each of these sites we effectively flash with raw customer material. And it is the case that when we sign transactions on behalf of our customers, we do so in such a way in facilities that are concentrated in some small city in such a way that the agents that are resident to those facilities do not have a way to collude amongst themselves in order to cause losses. So all of that to say that there is a fairly complicated logistical network that Knox implements, and it results at the end of the day in the ability for us to make the kinds of guarantees for our customers that let them rest knowing that the signatures that we attain for them are only attainable if they explicitly ask for them.
And also, I presume there's also some kind of use of Shamir's secret sharing as well as like a backup sort of sharding scheme there.
Yeah, so when we do the archives, I mean, there's 4 vaults per city per n, if you will, in the M of n, where n equals 4 scheme. We implement a 2 of 4 Shamir secret sharing scheme for each of those cities. So that results in a very large amount of redundancy in the kind of key generation layer. And one of the nice things is that we require explicit permission by other parties before we can ever access any of those layers. So effectively, what we do is while we maintain ultimate signing authority over the accounts that we generate, um, we do so in a way where, in the usual mode of operation, Basically, if you look at the private key life cycle, most of the time that a key spends in its life is spent in, call it the signing cycle. In that zone, if you will, our agents do not have access to the ability to actually attain signatures without the explicit permission of a customer. Whereas we do have the ability to, for example, do things like reconstitute an account if the customer should lose the ability to actually authenticate those transactions.
With all this COVID or etc. travel restrictions going on, has that presented a difficulty for you there in terms of access to the different keys that are located in different countries or continents?
No, so one of the neat things is that because of the way the system is constructed, most of our signing can occur in a single city, even though the accounts are ultimately distributed across the world. It is only in the very rare events that we need to reconstitute an account that we need to fly out personnel, and this is a fairly serious operation. It results in no less than 8 flights that occur for the active reconstituting account. In the call it the restrictions around the current context, the worst that we would have to do is that our agents would have to, because we reside in Canada, our agents would have to, if we're following the laws, our agents would have to quarantine for 14 days. But we're still capable of engaging all of those areas.
Right, and just for clarity as well, I mean, Knox is based in Canada, but presumably you have customers around the world, right?
Yeah, Knox is based in Canada. We really focus on Canada, the United States, and the EU at the moment, although we are looking at some other jurisdictions. Um, from our standpoint, obviously we spend a lot of time looking at regulatory concerns, but it is, we do service, folks around the world. It is not this is not a Canadian only story.
And in terms of how the customer interacts, I see there's the Knox terminal, and I presume then the customer can set up things like their own internal policies and spending rules on how many people need to sign or how many people need to approve for a spend, things of that nature, right?
Yeah. So one of the things that we received requests for early on was the ability to provide, multi-city support. So, people noted, okay, of course, you have your multi-signature set up. It takes many different facilities, geographically distributed to sign. But we, the customer, happen to be spread across 1, 2, 3, 4 cities. How can we set up custom governance structures such that we can actually engage your service, and be sure that we can get that kind of custom governance. One of the things we do uniquely is, at the moment, the method by which you access our service is with what we call a Knox terminal. This is effectively a hardened, purpose-built computer that is a window into your Knox account, and allows you to grant us authorization to move funds. One of the things we can do, though, is make make it so that you can do things like, require 2 out of 4 or 2 out of 3 or 2 out of however many terminals you have around the world, to actually authenticate some movement. So that is something that we have already deployed. So you might be in New York and London and Paris, and say something like, I wish to produce a wallet where I need both of, New York and Paris, or both of New York and London, to sign off before a transaction is allowed to move.
And in terms of if the custodian, like, so if Knox were to go under or go rogue, what kind of recourse is there for the customer? What kind of ability is there for the customer to basically get their money back?
Yeah, so it's something we spend a lot of time thinking about. The case law for Bitcoin ownership is still getting built up. One of the unique things that we're capable of doing is, because every account for a customer is ultimately made physically manifest, and because they're completely segregated right at the entropy source. One of the things we can actually do for customers is to, and we stipulate this in the contract, is to say that the customer owns the physical aspects of their own account, which renders Knox a kind of safekeep, kind of a warehousing service more than anything else. And what that means is that we can actually ride on existing case law to make it so that even in the case of something like insolvency, a customer would have ultimate right to the physical artifacts that render their account whole. And then that mixed with a basic amount of information that we provide them would allow them to actually manually themselves reconstitute that account. Certainly, it's not a situation we expect to ever get ourselves into. But one of the fears that we've had from the start is to say, what happens if the courts rule against us? What happens if, even though we agree with the end customers that, of course, they own this underlying Bitcoin, if somehow there's due to some strange kind of ruling that happens between our founding and this event, what happens if somehow the customers put is not allowed to access their funds, and that's something that we never want to get to. So that's why it was so important for us from the beginning to say that customers ultimately own that which constitutes their account.
Very interesting. So they, in some sense, are able to recover it physically and reconstitute all those pieces of the multi-signature shards, if you will, and basically recover the funds in that way.
Yeah, that's right. And really, this just comes down to you do not want to exist in like, you want to make sure to understand case law as it exists, and you want to make sure that what you've constructed can allow the customer to get at their funds based on kind of historic case law, not on presumptions as to how courts will rule.
How have your conversations with, say, regulators or other related parties been around? Have you had to have any around getting them over the line in terms of your setup?
Yeah, so I mean, each of the jurisdictions that we look at, we're certainly curious to see how everyone is moving. Ultimately, one great thing, and this is another great thing about focusing on Bitcoin is not a security. Because Bitcoin is not a security, a lot of the relatively complicated securities law oftentimes does not come into the picture at all. And we get to ride on kind of, and this goes back to the last point, which is how much of the system can we produce such that it can ride on existing case law, ride on existing jurisdictional assumptions. How can we make it so that we're sure that we're not going to overstep some boundary, and that at the worst, customers can get at their funds. So it was certainly a worry going into this, but I think we've been pleased to see that one, many jurisdictions are acting rationally. Two, Bitcoin clearly not being a security is something greatly in our favor, and that where we need to spend a lot of time kind of dealing with regulators, they are, at least to this point, they have been behaving. They've been behaving well.
So, what kind of prices can customers expect to pay for Knox Custody? If you could just break that down a little bit.
Yeah, sure. So our basic breakdown is as follows. The fee that most people focus on is the fully insured custody fee. So we charge 100 basis points for based on the amount of AUM that you're holding with us in order to get that one-to-one insured coverage. What's nice about this is that fee is less than the premium that you would be expected to pay if you built your own custodial system and attempted to hit insurance markets directly. So that's it's a natural point of specialization of labor, which is we charge less than you would be charged if you attempted this thing yourself. Otherwise, we charge typically a $20,000 setup fee and then kind of $5,000 per additional site for each terminal, and then typically a $2,500 per month, minimum AUM fee, which more or less for the 100 basis points fully insured coverage means that you should be holding about $2.5 million to make this economical.
Excellent. And so, also, could you break down a little bit the difference there in hot wallet versus cold wallet? As I understand, that's also a service you provide.
Yeah. So, and I suppose here we can talk a little bit about the roadmap. One of the things that we developed early on in order to get the kind of collusion coverage that we got from the insurance markets is the kind of collusion resistant tech, which makes it so that our own agents, even with physical access to the premises that they inhibit, cannot cause a loss. A neat thing about that is that if that is true, and it certainly is true, then if you kind of produce a network connected um, version of that custody system, then a network intruder, even if they have access to the network with the highest privileges possible, ought not to be able to cause a loss to be induced. And so that's kind of we basically parlayed a lot of the R&D that we've developed for cold custody into hot custody. It's something that we're testing with some of our current customers and something we intend to deploy kind of into Q4 2020. The other point, and this is still early days for this, is and it kind of comes into one of the questions that you had posed earlier. We're really keen to see how BIP 174 PSBT is going to lead to a world of different custodial setups, and certainly ones that span the spectrum from fully hold all of your own coins in a full quorum to these kinds of centralized custody systems as we've seen deployed. And it's something that we're really keen to. It's something that we'll see developed and deployed soon. And we really want to see what it means for either businesses, family offices, but then even in the medium term, individuals, what it means for them to actually custody with something that's something like a hybrid between kind of fully centralized and fully hold your own keys custody.
So I guess summing things up a little bit for a person who's got a large amount of Bitcoin, they're probably thinking, well, okay, 100 basis points. I mean, that could seem like it's an expensive cost given what it is. But I suppose it's also could be seen that given how early we are in Bitcoin, that's relatively cheap compared to the upside potential of Bitcoin. So I guess that there are probably a few thoughts people might have in terms of overall considerations at this point in time. Uh, what's your view on that, and maybe where do you see that evolving over, let's say, the next 5 years in terms of the cost for insured Bitcoin custody?
Yeah, so you can imagine we're quite committed to greatly reducing the cost of fully insured Bitcoin custody. I will note also that for 30 basis points, customers are capable of holding Bitcoin with us, such that they can use the exact same accounts that are otherwise insured one to one, without us buying necessarily insurance coverage. So that's definitely already a far more economical means by which folks can actually use our service. But we are greatly committed over the next few years to reducing the premiums that we pay, and when we get to reduce the premiums that we pay, we can produce corresponding savings for folks who wish to use our service. We do strongly believe though that one to one insured is something that for a lot of instances is necessary, and so far as we've seen, people definitely agree with us. But I agree with you that the rates are higher than they will be in a few years, and it's something that we're actively working to reduce.
Excellent. So who else is part of the team with Knox Custody?
That's a good question. So I think certainly it is the case that the team is nearly universally engineers, just software, hardware across the board. The kind of things that we needed to do, the kinds of things that we needed to build in order for this thing to really take hold, were almost entirely in the technical realm. We have between myself and others kind of a very strong interest, of course, in insurance, and spending a lot of time within that. On a lot of the team, I think a lot of us are quite technical and oftentimes fairly introverted and not exactly out there. For those who are more out there, I would say, myself and certainly Thibaut, who I'm sure yourself and other listeners have seen, Tibem, have, you know, it's really us two who are more vocal than anyone else. But yeah, the team is quite deeply technical, and something that I'd expect to continue seeing in this company. At the end of the day, when you are in these kinds of nascent industries, just an ability to just build next generation software and hardware is critical.
Alex, where can listeners find you and follow you online?
Sure. So yeah. So myself, I'm on Twitter at Daskalov, and then otherwise you can find us Knox at Knox Custody. And I suppose these will be in the in the notes on this episode. But yeah, it's was really great speaking to you, Stefan, and definitely if anyone needs fully insured custody, you know where to find us.
Excellent. Well, yeah, looks. It sounds to me like you're doing some really interesting work, and I'm excited to see where things go with this. Thanks for joining me.
Yeah, thanks so much, Stefan.
Get the show notes at stefanlivera.com. Thanks, and I'll see you in the Citadels.